And so if you don't have the check equity, then you need to be very valuable, like have knowledge, skill sets, and abilities to go find deals, analyze them, raise the capital, put them together, close the escrows, and manage. And if you can provide those things to people with money, sky's the limit.
What's up, everybody? Dan Haberkoss and Mason McDonald coming at you with another awesome episode of the Big Picture Blueprint. Got a big multifamily operator on the show today. How's it going, Mason?
It's going well. I think that we have a really fun episode today, and I appreciate some of the simplicity of this guest strategy. And, you know, it's December. We're all looking to grow. I know he's looking to grow to huge numbers. So I think we have a really good episode ahead of us today. And on the show today, we have Justin Brennan. Justin serves as the CEO of the Brennan Pohle Group, a premier private real estate firm specializing in the acquisition and development of apartment complexes across the United States, with a portfolio encompassing 500 plus units and assets totaling over $150 million. Justin and his team are dedicated to steadfastly working towards expanding their holdings to $1 billion in assets. Justin is deeply committed to giving back to the community and supports causes such as Tunnels to Towers, the Seal Future Foundation, and St. Jude Hospital. So without further ado, let's bring Justin in. All right, Justin, how are you doing today?
I'm good, man. Thanks for bringing me on here. Happy, if I didn't even say the day of the week, but Tuesday.
Yeah, it is Tuesday. It's December. This episode should come out before the end of the year, so it'll be really applicable to everyone kind of figuring out what the market looks like in end of 2024, beginning of 2025. But Justin, first question I have for you is, there's a lot of people in this real estate investing world, this entrepreneurial world, that are very anti-higher education. They are against people going to college. They're against people going to graduate school. What do you say to that?
I say the traditional model of college education is changing. We can all agree with that because of the cost, the cost benefit analysis that people do. They say, I'm going to spend $250,000 and go to college, and most people are having to take that out on student loan debt. So does that make a lot of sense to really jack yourself up with $200,000 worth of debt that's going to be at X interest rate, and then you come out and you're getting an $80,000 a year job where you basically start from a negative and you're never going to catch up? So if that is the game plan, then the answer is probably no, right? The answer is probably no. It doesn't make sense to go to the traditional 4-year, vocational college stuff and do all of that. But the connections that you make when you're there is everything. And I don't think I picked up on that until probably my junior and senior years, where I really began to leverage the friendships, the connections, the people that I met in college when I was there, because that is worth its weight in gold, right? If you're going to go pay to play, then you need to understand that is a massive 4-year network opportunity. I mean, screw what you're going to learn. Mm-hmm. I want to know who I'm going to meet, because the more hands you shake, the more money you make. It's that simple, right?
Well, and that's funny. I remember welcome week at, during kind of fraternity rush at college, and this big old fraternity guy came up to me and was like, man, it's not about the grades you shake, it's not about the grades you make, it's the hands you shake. And I was like, oh, this guy doesn't know what he's talking about. And then, in hindsight, you realize that. And I think it's funny where, because I totally agree with you. And it's probably because I also, went to private school for grad school and undergrad, and will pay it off forever. And, I think you learn a lot and learn a different way to think. You're exposed to a lot of people, and the friendships you make and the network you have, especially if you go to expensive schools, you get to know people that are on usually a pretty decent trajectory. So it's what you make out of it. But all that to say, I'm clearly biased too, and it's probably just a defense mechanism for how much money I've spent on college. But you're in the real estate world. I've listened to some podcasts about you. You got started with, I think, of a college friend or a grad school friend. Can you tell us a little bit about your journey of getting started, of the 90-second, 2-minute elevator pitch of where you got started and where you are today?
Yeah, so I came learning from my parents and grandparents to kind of from day one. My grandmother, 91, God bless her soul, was driving around in an S10 truck in South Bay, San Diego, collecting rent on her 40 units. She had multiple properties, but she owned them free and clear herself. Okay. And she'd literally drive around till she was in her mid 90s, little Italian lady knocking on doors, pay me my rent. And that's how I understood kind of that game to start. But I didn't understand the value of apartments really then because I was too young. But I grew up learning from my dad, who was a builder developer guy. And he came out of the Vietnam era, bad upbringing, but he got into real estate brokerage and then realized that was his deal. Got into development and got into building single family homes, and then got into subdivisions, like doing small community tracts of single family homes, and then grew into the multifamily space of condos, townhomes, and then large apartment complexes. But he would always build and sell them. He would never build and hold. And so that's great because he makes big pops, right? As you kind of mimic the real estate cycles, make a bunch of money when the market's great, but you lose your ass when the market's not. And I saw that, and I was like, how do you sleep at night? How does this work? Because I need some level of consistency in that. And so, I was blessed enough that he didn't have the high level education, but he gave it to my brother and I and sister and everybody. So because of that high level education, I would say what I did learn in grad school was, the value of consistent cash flow, right? And the one common denominator amongst all of my friends, and their parents maybe were in or not in the real estate industry. They could have been doctors, attorneys, didn't matter what they were. There was one common denominator. They all owned rental income property. All of them. Every single one. Every single one. And so I saw that and I was like, okay, we can go do the build and sell game. We can flip houses. We can wholesale. We can do all these other things, and they're all great. But at the end of the day, what you want to do, like the best thing anybody can do is, if you're a flipper or a wholesaler or doing stuff that's more transactional right now, is you take that transactional money that you're making and you start pivoting a portion of it, or as much as you can, into longer term rental income type assets. And I don't care if it's an Airbnb or it's a 10, 20, 30, 50, 100 unit apartment complex. But you take the short term and you move it into the long term, because that's how you're going to get the best tax benefits, the most write-offs, and that's how you're going to truly get wealthy. And once I saw that, that's kind of what got me into the apartment space. But I came through, parents and grandparents a little bit, kind of learning it, but then I had to kind of dive in deeper myself. So.
Okay, awesome. So when you got started, what, approximately what year was it, and what did that first buy and hold deal look like?
So I came out of the financial crisis. So if anybody's watching this and went through 2008 through 2010, they understand exactly what that was. And I watched my dad go through a $60 million bankruptcy. It was the craziest thing I'd ever seen. Someone that has built, at least in his case, a little mini empire for 40 years of his life, and then watching it all go up in flames very violently and very quickly. But a lot of people were getting hammered then. But what that did, that was 2008. And then by 2009, I became an asset manager. I got a chance to become an asset manager for a lot of the major banks, handling the REOs and foreclosures for them nationwide. So that got me into this asset management type thing of how to manage properties. And it wasn't until like 2010 where my current business partner and I came together and said, hey, we want to start buying properties. Like, I didn't have any money. I was getting my butt handed to me, but he did have some capital. And so we literally started with a $100,000 condo in Murrieta, California in 2010. Right? That was it. We put $25,000 down, got a $75,000 loan from Wells Fargo, and the thing cash flowed at like 13%. It wasn't a lot of money, but the metrics were great. And then we turned that $100,000 condo into a $310,000 sale. So we made some money, a little bit. Then we bought a single family home. Then we got into duplexes, triplexes, quads, like fourplexes. But most of it was with our own money, right? And that was great, except when you start to run out of your own money. And so if there's anybody kind of here saying, gosh, I'm kind of in this similar position where I'm scared of raising money. I don't want to take money from other people or use other people's money. I want to do it all with my own. I'm telling you firsthand, you're really missing out on the beauty of what real estate is. Because to truly do this correctly, you need to leverage your money in conjunction with this beautiful thing called OPM. And that is other people's money. Because everybody wants to invest in real estate, right? Everybody does. That's not the problem. It's just that people need a deal that makes financial sense, and they need a trusted source to invest alongside with. And if you provide those two things to most people, then you can raise money left and right. But that's kind of how it first started. It was that first condo. Then we got into quads and triplexes, duplexes. But our first larger kind of syndicated deal was a 27 unit in 2018 in Kansas City, Missouri, out of state. That was our first deal where we actually did a true syndication, bought it for $2 million, raised $800,000, got a loan for $1 million and whatever change, renovated the deal, value added it. We're still holding it today. And we did a traditional BRRRR method, cash out refinance, like everything you see and read online through YouTube, that exact value add story we did. And that was our first deal. And we raised that $800,000 from 7 people. We brought in about $65,000 of our own physical cash into the deal, but we also got a $45,000 acquisition fee the day we closed escrow. So you can do the math. We're $20,000 out of pocket, and we have control and ownership of a $2.2 million asset, right? For $20,000.
Yeah.
Like literally $20,000. And so when people tell me, oh, you need a lot of capital. No, you need a lot of capital if you're trying to do it alone. You need a lot of capital if you're trying to do it alone. But you either bring check equity or sweat equity, right? Check equity or sweat equity. And so if you don't have the check equity, then you need to be very valuable, like have knowledge, skill sets, and abilities to go find deals, analyze them, raise the capital, put them together, close the escrows, and manage. And if you can provide those things to people with money, sky's the limit.
Yeah, absolutely. I think you could come up with a fun tagline from a $100,000 condo to a $1 billion portfolio or something like that, because I know that's what you're pushing.
Wait, yeah, when we hit the 1 billion, I'll definitely pull that off.
Yeah. How many orders of magnitude is that? That's pretty cool. But anyways, okay, so that first portfolio in Kansas City, you syndicated it. How did you put that together when, at that level, you're newer, you'd been doing business for years, but at a, it sounds like smaller residential level. How did you put that together? And what would you say to people who are kind of at that threshold where they're not new, but they've been using mostly their own money and they want to scale by raising a substantial amount of capital?
Yeah. Like I said, you have to have the sweat equity, like the knowledge, right? Right. And if you don't have that, you need to learn it. So there's different ways you can learn it, right? If you want to go learn it on YouTube, by all means, there's plenty of people talking about it. But at the same time, I always say you can give people all the information in the world, but they need to know how to use it. Right? I mean, having the information is great, but you need to know how to use it. And so that's where people will obviously invest in more education, mentorships, hand-holding, stuff like that. But you need to have the knowledge, because if you're extremely valuable knowledge-wise, then the money game is not as important, because you can find people that have money who will invest alongside you. So if you're brand new or newer and you're trying to kind of level up, let's say you've been flipping houses for last 5, 6, 10 years, wholesaling, whatever it is, or other areas in real estate, Airbnbs, other things, and you want to kind of level up and buy your first 10 to 30 unit apartment building. So step one, don't go too big. Your first deal should be right in that pocket, 10 to 30 units. 10 to 30 units. You have a lot of gurus out there, and I literally teach this stuff all the time, telling you your first deal should be 50 plus units. And I'm like, dude, yeah, I understand why you're telling people that, but they have no chance in hell at executing at that level if they've never done it before, or if they're newer to the game. Ain't going to happen. I mean, they literally have a better chance of going and trying to break into the White House tonight than you do of getting a 50 plus unit deal. If you have never done one before, and people that you're partnering with or doing deals with have not done it either, no chance. Brokers aren't calling you back because you're dealing with a more sophisticated broker. Lenders aren't giving you the time of day. You have nothing to show them. You have no track record, and they're going to require that if you're trying to go that large. Sellers aren't going to deal with you because you haven't done it before. People aren't going to give you money to go do it because you don't have a track record. So you're like peeing into the wind. But you have people trying to teach that, and it just doesn't work. So what is possible is a 10 to 30 unit, which is no different than I did. I mean, I tell people exactly what I did. We hadn't done that before. It was our first deal. And we didn't need 100 people to invest with us. I needed 7. And we got the 7 people because all I did is I had a deal that made financial sense. Like the deal's metrics were returning an 18 to 22% return annually to the investors. The metrics told me that. Good cash on cash return, good IRR, go to equity multiple, because those are really the three metrics that people should follow. Is it should produce at least somewhere between a 14 to 20% annual return on an investor's money. It should give you a 6 to 10% plus cash on cash return. And it should have an equity multiple of 1.8 or more. And if it meets all three of those metrics, you'll dive in deeper. If it doesn't meet all three of those metrics, you move on. And so that's kind of the starting point when you're looking at deals. But if it meets those, then you have a deal that makes sense. Now you need a pitch deck. And if people don't know what pitch decks are, all they are is a PDF PowerPoint put together that describes what the deal is, how much money you're raising, what are the potential returns for investors, and when do they get their money back. I mean, that's kind of what a pitch deck does. It answers 95% of the questions that any potential investor may have about you and the deal. So if you have the deal that makes sense, a pitch deck that describes it, and then a process for bringing that money in, it was not hard to raise the money. I sent out 3 emails to like 55 people I didn't have a big database either, but I said, hey, I'm going to send it out with a little video in the pitch deck telling people we have the deal, because we had it locked up. I just literally locked up the deal and was putting it into escrow. And now I had something that was real, and I had a deal that made sense. And then all of a sudden, if people like you and trust you, the money will find its way if the deal makes sense. Does that answer your question? I know it's long-winded, but
yeah, absolutely.
Yeah, and that was really good. And I think people could go back and listen to the last 3 minutes or 4 minutes or so and break that down. And I want to try and kind of establish some through lines here of you had a higher education and, the school of hard knocks, learning from your, mafia grandma that's going and collecting rent checks at 90 years old. And your dad being a developer, but also the professional higher education, which teaches you some of the financial vocabulary and, additional stuff that you might need. You also had a career where you learned how to make money. I think a lot of people forget that you need to make money before you're investing. And in order to provide that sweat equity, whenever you don't necessarily have enough capital to be like an anchor LP or a huge LP in a deal, you need to actually know what you're doing. Like, yeah, you can say, hey, I'm going to work really, really hard, but I don't know what the fuck I'm doing. So, that doesn't really help.
And just think of it. I mean, if I were coming to you and we were going to partner on a deal, there needs to be added value. So if you say, you guys are like, yeah, we can provide the cash equity, right? The check equity. We have $500,000 we can provide. But we have no idea what we're doing. But if you guys came to me and you said, we can provide you $500,000, Justin, but we have no idea what we're doing. And then I came and said, well, great, guys, I don't have any capital right now, but I know how to do this thing A to Z. Yep. So now I'm bringing something to you that you don't have. You're bringing something to me that I don't have. That's a potential beautiful partnership.
Well, and there's so much
value add. You're bringing the check equity. I'm bringing the sweat equity. Let's rock and roll.
Absolutely. And there's so much disconnect there between the operator or the sponsor and a lot of the money out there, whether it's the retail investor, the high net worth individual, or the institutional investor. And I want to talk a little bit about what it's been like it's coming on the end of 2024. And, the market's been weird the last couple of years, in capital markets specifically. In today's world, can you send an email to 50 random contacts and raise all the money you need for a syndication? Or what's it been like raising money for deals now?
Yeah, well, it's getting better. But yeah, 2022 and 2023 were a complete disaster. I mean, I can tell you some horror stories, and there's plenty of syndicators that have lost their ass all over the place because of the interest rate hikes that started in March of 2022, as we all remember. I think it was 11 rate hikes in 9 months, if I'm not mistaken. So we've never seen that precedent before, ever. I mean, we've seen interest rate hikes, and we weren't dumb. I mean, thankfully, knock on wood, and I was telling one of our partners the other night, because we were in escrow on 4 deals in between 2022 and 2023. And we ended up closing on 1 of them and backed out of 2. 2 of them got our money back. 2 of those deals got our money back because of some issues in escrow. In 1 of them, we had to walk away from $800,000. I mean, if you want to pucker up, I mean, have yourself make a decision that you have to leave a deposit and all that stuff on the table, because trying to fit a square peg in a round hole and, potentially risking $12 million of investor money is not worth the risk. It's just not. And so we, as the GPs in that deal, had to walk away. And that was a 200 unit deal in Texas that we went into escrow, the financials looked great. Obviously, as rates continue changing, halfway into the escrow, we're like, number one, we can't raise the money because everybody's seeing everything fall. And the deal no longer makes financial sense. I mean, we could hardly get a loan. So we had to make the decision painfully to walk away from it because we had money hard at that point. It was a really rough decision. So that set us back. I mean, because we're not sitting here with zillions of dollars, but, we were able to fight through that, and kind of where we're at today is still holding on and doing okay. Where there's a lot of people getting their ass. I mean, syndicators have lost a lot, and a lot of people that have been invested in these deals have lost a lot. Whereas we've been able to preserve and save our deals, and most of them are doing pretty well. So,
well, let's talk about it, Justin, because something I really respect there is most CEOs, one of the biggest causes of failure with CEOs is the sunk cost fallacy of like, you keep just pouring money into a project or a deal or something like that because you believe it's going to work, you're going to make it work, you're going to force it to work, and then you end up losing everything when you could have just ripped the Band-Aid off before. But walk us through, kind of the whole picture of that deal, what it would have looked like if you had gone through with it. If there was, any potential lessons learned from that and how you would have potentially done it differently, with all the knowledge you gained.
Yeah. The biggest lesson takeaway, there's a difference between doing the right thing. I should say there's a difference between doing things right and doing the right thing. So doing things right, meaning your boss comes to you and says, hey, we need to hit 20% profit margin this month or this quarter, do whatever it takes to make it happen. Well, you may have to do some shady stuff to get to 20% profit margins that may be out of alignment with doing the right thing. So that leads right to it. We could have closed the deal. We could have fit the square peg in the round hole and closed on the 200 unit deal to avoid us as the GP losing $800,000. Okay. But now we're in something that I knew intuitively it would be back to the bank. Like, if you asked me that question, what would happen? Like, the property would be back to the bank. And then we had $12 million of investor money that would have gone with it. So I couldn't make that. I could not make that decision to do that, knowing intuitively what we were potentially putting ourselves into. I just couldn't do it. Now, to show you how well that pays itself forward in the universe, literally all of that money that was in that deal with us, because we took it the shorts as a general partner. We had another deal. We ended up buying in San Diego, a 76 unit in National City. And Dan, you'll understand this location wise, that we have now made a 78 unit. And all the money that was in that Texas deal, because of the way we handled it, we're like, holy crap, kudos to you guys. Because a lot of times the GP will risk the LP people's money in the escrow. We don't do that. We won't risk the LP until we close. So that's kind of one unique thing that we do. But all that money came over because they saw how we handle it, and they saw the deal in San Diego, which was a great deal because it made great sense even in the tougher market. And that thing's going to be an absolute freaking home run. And so lo and behold, you do the right thing, you see what happens. Right. So.
Yeah, those relationships are more important than losing there's a big check, but losing that earnest money check.
Yeah. And that's why I've been fighting so hard on, I'd say the only deal in our portfolio right now that's challenged was a deal. And to be fair, any deal, any apartment syndicated deal that was purchased between 2021 and probably first part of 2023, right? Any deal purchased in that window is getting hammered and is struggling right now, just because of the interest rates and stuff like that. So one deal in particular in Texas right now that we're working through that's challenged. I mean, it got to a point where I had to make a decision to move out to the property, and because we were on variable rate debt, we'd purchased the property in the end of 2021. Great time, but lo and behold, now it's the peak of the market. And then interest rates start to change in March 2022. So I'm seeing this happen going, oh boy. But it was one thing for them to go up a little bit, but then I kept seeing it go, like that, like straight up vertical. And I'm going, these guys are out of their mind. They're going to implode this thing. So I had a conversation with our partners and I said, guys, I can see this coming. I said, we've got to get into fixed rate debt or we're in deep, creek. And so they said, Justin, are you willing to move out to the property for a little bit? Because we had to get the renovation done and the teams weren't moving fast enough. We had to get renovated, finished, released, new rents so we can actually get the property ready to put a new loan on it and refinance that property into fixed rate debt, right? Versus the variable rate mortgage we had on it. And so, I moved out to the property for a couple months, worked with the renovation teams, bird dogging that thing every day to get it across the finish line. And we got the renovation done. We got the property leased up to 98% with all the new rents and literally squeezed that thing across the finish line about a week before the 10-year treasury went through the roof. Mm-hmm. And if everybody knows about how commercial loans are put together, they're based on the 10-year treasury. So the 10-year treasury note is what dictates a lot of the commercial loans in the industry. So that thing went from 0 to hero. And, if we didn't get that thing done and locked in, the property would have gone to bank.
Yeah.
So you alluded to something I want to hit on, where one thing I do like about, I have a bunch of duplexes and fourplexes and houses, and they're on 30-year fixed rate term, which is great. And so given the last few years, it's kind of two questions here. One, have you ever considered raising the money to just buy these things outright so you don't have that risk of variable interest rates and then loans coming due? And then number two, if it's a no to that, how are you structuring these deals? What sort of debt are you getting going forward to help mitigate that risk?
Yeah. So to answer the question, no, you never want to pay off any real estate asset. I'll be very direct. That's about the dumbest thing anybody can do, mainly because there's good debt and bad debt in the world. And if you want to get truly wealthy, you leverage good debt on a real estate asset. You allow it to cash flow itself. And then what you do is you pay that down over time, but then you leverage that. You take out a cash out refinance because it's tax-free money when you cash out refinance, and you go buy more properties. So debt is a good debt when it's good debt, meaning fixed rate, right? It's bad debt when it's what you're talking about, when you get into construction loans that can change, where there's market volatility and all those things. So all of our deals are fixed rate debt. The only one we had that got into variable was that particular deal. And you can get caught. So obviously we'd never seen precedent like that where normally when interest rates rise, right, they go up in quarter point bumps, and it usually takes a couple years for those rates to rise. So there's time for the market to absorb. Well, when you go 11 interest rate hikes in 9 months, you don't have time to absorb squat. You're just sitting there going like deer in headlights. So that was the problem. It wasn't so much the interest rate hikes as what is the speed and the velocity which it happened. Yeah, freaked everybody out. So, good leverage, don't over leverage your properties. I can tell you right now, the only reason we still have that asset and we're holding on to it is because we did not over leverage it. So we typically never put more than 65 to 70% debt on our properties. So that's the key. And that is one thing I did learn heavily through the financial crisis and in school and talking to many other very wealthy individuals that own properties. Just don't over leverage. Like, debt's good. It's just don't over leverage and make sure you're fixed rate debt, because that allowed us to get into the debt we have today. So I'd say that's the key to it. Is just don't over leverage and ideally fixed rate debt.
Yeah. No, that makes sense. All right. So 2025 is just around the corner. It's December the 3rd. You're pushing towards $1 billion portfolio. What are you seeing today in the market? Where are you really excited about? And what's your outlook for multifamily, both in the short and long term?
The next 12 to 18 months is going to be challenging because we're still dealing with, when I say challenging, for the commercial real estate industry, specifically multifamily and office. But with multifamilies, you still have this triage going on where you have cap rates are starting to flatten out, meaning they're not rising anymore. Valuations are starting to stabilize, right? They were falling there for quite a ways, and there's still issues going on because you have properties that were highly over leveraged, overvalued, and they're not producing the income. So I would say the one challenge right now in certain markets that had a lot of high growth, and you could take that anywhere from Nevada to Arizona to Texas to Florida, anywhere, and I call it the up down or upside down Amazon smile, right? The Sunbelt states, as they call it. You had a lot of high growth, so a lot of new construction was built, and that stuff's not being absorbed yet. So the next 12 to 18 months, we have to absorb that inventory to allow rents to flat and stabilize, because right now rents are still dropping. And so it's putting a lot of pressure on these properties. And that's going to be a challenge all the way into 2026. So to answer your question, great time to buy. If you're going to buy now. Because come 2026, I'm telling you, you just look at the data, because they're not building anymore because of construction costs and interest rates. Like, inventory stopped. So anything that's under construction is going to finish. Anything that was built is done. They're going to absorb that inventory over the next 12 to 18 months, and there's no new stuff scheduled. So what do you think is going to happen? You're going to have an inventory problem. You think you have a housing crisis now? Just wait. I'm telling you, 2026, get ready. Rents are going to start skyrocketing again. And cap rates are going to compress. You're going to start to see valuations being able to jack up again. But you want to buy now, because if you wait, you're going to be like, oh crap, I should have done it. So I'm telling you, like, buy. When you're done buying, buy some more. And now's the time.
There we go. Yeah, I saw today, I'm in Colorado Springs, the first multifamily permit that had been issued in about 6 months occurred today. So it's, which Colorado Springs, it's that thing of, they're like got 20,000 multifamily units coming on the market, which is going to take a long, long, long time to absorb.
I didn't know it was that heavy in Colorado Springs like that. Wow.
Yeah, I wouldn't want to be in multifamily right here.
What's the demand look like? I guess I don't worry about the supply. What does the demand look like?
There's a good amount of demand here, and there's, affordability crisis like everything. But with multifamily, it's hard to say, what the market absorption is going to end up being like, because it feels like a lot of units.
Yeah. I mean, that is a lot of units. I mean, the answer to your question, but yeah, if the population growth and job growth is exceeding that, because that's really what you want to look at is, where are the jobs coming from? They're going to help feed that, because the population will grow with the jobs, right? If the main job providers are coming into the area, or if they're expanding, then the population is going to grow with it. And then those 20,000 units, while seems like a lot, may not be. If growth is there. Yeah.
Oh yeah. Well, and so kind of on what we're talking about of new units coming online, value add units, and then just kind of turnkey rentals, which it seems like that's what your group targets. How does your approach differentiate itself in each market that you're in? Are you doing new development in particular markets? What are those indicators versus doing a value add versus just doing a turnkey from an acquisitions perspective?
Yeah, that's a great question. Right now, most of we will do mostly existing purchases of existing product. And the ideal target range for us is like kind of like a 1980 product or newer, Class B asset. We will do some Class Cs, but we want to be tactful with that, because you just have to be, if you're going to do a C, then you just need to underwrite really well, because it's going to have more improvements. You're going to have more repairs and maintenance, more stuff that's going to put a burden on your profit and loss, right? In your ability to cash flow that property. So you just need to buy it right. Because if you overpay for a Class C, which we've done before, and then you're like, oh man. So you want to make sure you don't do that. That's a critical piece to the Class Cs, is really doing good due diligence. But yeah, we're buying existing product, Class B assets, 1980 or newer. There's a lot of markets we love. I mean, Nevada's a great one. Arizona's a great one. Texas is a great one. Missouri, anywhere in the kind of middle part of the country is great. And I'm even starting to like kind of the upper Midwest. I mean, I kind of like the Ohios and the Indianas, even though I don't like the weather during the cold seasons, but there's a lot of growth happening there. So I'm interested in that. Obviously, the Tennessee market has been hot for a while. Florida market is incredible, except for the insurance problem. But there's a lot of growth happening. I'm very optimistic. I do truly believe that you're going to see energy costs drop. So this is the key thing that people don't understand what's coming in. With deregulation that's going to be happening with the new administration and energy costs, because it all starts with energy. People want to know how inflation happens and why the cost of all the groceries and products and foods and widgets and all those things are through the roof. It's because energy costs are through the roof. And when you open up the energy sector and you allow supply to kick in and start fracking and drilling and doing things, obviously eco-friendly, but doing it the right way and becoming energy independent again, that's going to drive everything down. So all your cost of goods sold, products, manufacturing, everything drives it down. And that then allows the stuff that you're talking about. So not only do you stop the rate of increase of prices, but you could actually even see prices drop. And so that's a key component. And I know the new administration is going to be doing that and deregulating, but also increasing supply to move us back to an energy independent and being actually an outsourcer of energy like we were before versus buying from the Middle East and all these other places. People don't understand the power of the energy costs, right? I mean, they feel it in the pocketbook, but they don't understand really where, like the core foundation of where it comes from. You got to drop the energy costs because everything, I mean, think about all those extra fees, surcharges and extra fees that are in all of these costs. I mean, why your avocados are so high and your eggs are so high and all these things is because there's all these costs of energy surplus added into them. So,
yeah, absolutely. It'll be really interesting to see how it plays out. I feel like a lot of us are cautiously optimistic. There's some current concerns, obviously, with some of the tariffs that are being talked about of some building materials and costs going even higher. But we'll find out when we find out. But
that's just a good negotiation tactic.
Yeah, right. That's what we hope.
But he's serious about them. But the people who will get those put on them, it'll be all right.
Yeah, and that's how we feel, and that's what drives a lot of economic behaviors too, beyond like foundational, economic indicators of commodities. It's also just the general sentiment and feeling because we're irrational beings, and that's why I love learning about how irrational we are and human behavior's impacts on the economy. But
isn't it amazing though if you kind of look back or in where they say the past is no indication of future success, but you have nothing else to bank on. Mm-hmm. Right. So you do have to consider it and look at it, which is why looking at the interest rate thing that happened, we'd never seen precedent like that before. But now it happens. You could say, oh my gosh, we actually have had that happen. But yeah, you see how people react, and then you learn lessons from it, hopefully. And I have. What are you guys planning on? And what are you guys looking to do?
Yeah, I think for both of us, so Dan and I both own land acquisition, sales, and minor development companies. Dan does a good amount of new construction, single family, small multifamily. We're both pushing heavy for acquisitions right now. In the markets that we operate in, while there's been some stagnation on new construction because of all the stuff that we're talking about, I feel like in some of the areas that I'm doing business in, where you're able to do manufactured homes, much more affordable housing, a little bit more rural acreage. There's significant increase in demand going on as city and suburban flight occurs, which is a continuing trend that's been going on kind of since the pandemic, and I mean in general forever.
How many with the manufactured housing? So obviously everybody throws out that term and everybody thinks mobile home, but it's a lot different now, right? Because a lot of the stuff is built inside of warehouses, right? Maybe not all put together, but a good portion of it. And then walls are then, stacked on trucks, taken out to the sites, but they're, put together faster. Educate me on that a bit because it is a wave of the future. I do believe that.
I think
more cost effective.
I think one of the common misconceptions about it is it's way cheaper than stick built. And in general, it's not. It's about the same, but it's much quicker, depending on kind of the supply chain.
But then it technically is cheaper on the project because you're not having to carry
exactly of the cost of material versus the cost of capital and kind of how that functions. But I mean, in some of these markets, as long as it can get FHA type financing, which a lot of them can. It's making sure that you're doing it with homes that pass the regulations to be financeable. I think is where there's a good amount of opportunity, at least that I'm seeing kind of in, the rural parts of Colorado. I know, and Dan can kind of speak about what his plans are, but yeah, I'm focusing on a lot of larger rural acreage, in my backyard, as well as infill lots in, the Southwest, primarily, Arizona, getting up into, eastern parts of California, parts of Nevada, as well as where I'm targeting.
Now, how are you doing that out of state? I mean, are you, in terms of your organization and logistics, like let's say Arizona, Maricopa County, I'm guessing, or wherever else, you're finding lots and doing small subdivisions or just one-off homes?
Small subdivisions, but we primarily do land flips. So buy land for cheap, sell it for more, direct to seller marketing funnel through direct mail, cold calling, texting, that sort of thing. Have local realtor partners that help us evaluate the deal, and then we buy it for, 10 to 70% of market value, and then just relist it. Typically, the end buyer.
Subdivision land, or is it like a single lot?
Both.
Okay.
So yeah, it depends on what the exit strategy is. If it's an infill lot in the middle of a community, obviously you're not going to subdivide it. But if it's rural acreage, R43 in Maricopa County, where it's 5 acres, pretty easy to split into, as long as they're 1 acre lots or more, not too bad, and you're keeping it under a five lot. So we don't do major developments, at least not yet. We don't plan on it. Just minor subdivisions, ag type subdivisions. But we're optimistic going into the new year.
Yeah, I just to add, Justin, I do a lot of business in the Carolinas and Florida, and the markets where you can still buy a house for $200,000 or a new construction home for $250,000 are not stopping. And in Florida, I would say look to the parts of the state that are higher, and insurance is not as big of a deal because they're not in the flood zones. Marion County has been excellent, for example. And then on the buy and hold side of my business, that's all in Colorado. Been slowly and steadily buying rental properties for years. And one thing that I think often gets lost in these conversations is there's a difference between people like you that need to deploy large sums of capital. The amount of assets available, right, as you go up bigger and bigger, becomes smaller and smaller. And so, I've been buying in Pueblo, West Colorado, and rents haven't come down. The market's really strong. Those are great properties.
Are you flipping? Is that?
No, that's where I buy and hold. Those are because just like you said at the beginning of the show, I make money with the land business, and then I buy and hold nice assets as my investment. Okay. Right. And so, if you're just an individual investor building and keeping duplexes or fourplexes, you can get really specific and find good deals amidst markets that might be oversupplied. That gets harder as you have more and more capital to deploy. You're playing at a different level.
Well, yeah, no, 100%. And yeah, you're right. When you do go bigger, there's more people playing in that space per se, but there's less assets to actually go around.
Yeah.
So,
yeah. So anyway, so that's what we're doing.
Yeah. Well, Justin, let's talk about your org chart. I'm looking on your website at your team. Two-part question of what does your day-to-day life look like now? And your involvement in the Brennan Pohle group, and then what's your team doing? Who reports to? How is it kind of structured for what you guys are doing?
Yeah, so my typical day up at 5 a.m. or earlier, depending. I'll do the little morning routine thing that some people do, some people don't. But I'll start asset management stuff in the morning with some of our team to kind of get some things out on some of the properties. When I say asset management, it's the managers managing the managers, right? So my role in some of the assets that we own around the country is to ensure that the property management companies that we've hired are doing their jobs, right? And or some of the properties that we're self-managing in-house, our teams and stuff are doing their jobs on site. So that'll be kind of the asset management stuff earlier in the morning to kind of get that going because it's usually in other markets right now. Once that happens, then I'll actually meet with the team running the education company, Multifamily schools, because there's a whole thing that's going on with that where we're helping a lot of people get into this space, whether it's multifamily or other parts. But there's that'll happen in the morning, and then handling a lot of admin stuff in the afternoon, and getting on a lot of phone calls and handling that, and then doing some training stuff that'll happen in the evenings with other people too. So it's kind of the typical day. Because you have to have, even though our office admin is small, right? Where you have 5-6 people, all the properties are independent, right? So they have their own teams on each asset that we own around the country. So while they're not necessarily an employee, they're still contracted for that.
Makes sense. Okay. Yeah. All right. Well, Justin, we are reaching, I know we have a hard stop here in nine minutes, so we want to move towards the end of the show. So first thing we like to ask, are there any questions that we didn't ask that you wish we would have, or you think would have been pertinent?
No, I like getting to know more about what you guys are doing too, because on the land flipping side, that's super interesting. You guys not done like house flips, just land flips?
Yeah, I've bought and rehabbed and kept a number of houses, but never flipped them.
Okay. How long does that land flip typically take? Is that like is it a double escrow type thing, or is it you're going to hold it and do some land work to it, or
it's a mix. I mean, some of these things we're assigning or flipping in 30 days. Some of them it's 6 to 9 to 12 months. So it's a mix, and we try to have the short with the long, and then I'll do some new construction as well.
Right. Yeah, and I guess with that, do you get the sellers to allow you to option them versus having to close before you do this land work?
Sometimes. Totally depends on the avatar. You get some people that are sick of people trying to do some form of wholesaling, and so being able to actually close is a big part of the value proposition. And then there's another group of kind of the avatar where, hey, give me my price, and I don't care if it takes 90, 120 days, as long as I get my net. And those people that works well with.
Gotcha.
Yeah.
Yeah, because obviously the land entitlement process, like you said, depending on what market you're in. I mean, if you're California, 14 years.
Yeah.
Other markets are much faster, so that's good.
Yeah. All right. Well, with that, where can people find out more about you? What all are you doing? How can they participate?
Follow on Instagram. So you can go to official Justin Brennan on Instagram, or you can check out our capital company. That's BrennanPohle.com. That's BRENNAN, and Pohle is POHLE. So BrennanPohle.com. That's our capital company and all that. So, check us out online on Instagram. It's always the fun part. Love to connect with people on there. So,
yeah. And then tell us a little bit about the multifamily school, the education stuff you have going on.
Yeah. So that came about organically really the last 2 years. So as people were kind of seeing what I was doing, we're buying multifamily, doing the value add thing, all that stuff around the country, by nature, people kind of be like, oh, what are you doing? And then, hey, I kind of want to get into that. I want to learn it myself, so can you teach this stuff? And initially I was kind of like, I don't know. I don't have really the time. It's a lot of work. But then we put some courses that people could just take at their own leisure, online and kind of learn it. And people loved it. But then they said, hey, we'd really like more of the hand-holding, because all the information's great, but if you don't know what to do with it, it's pointless. And usually people like to alleviate mistakes and speed up the process. So that way they're not having to spend a year, 2 years, 3 years making mistakes and going through problems. They can actually fast track the process, learn it. And so that's kind of where the mentorship came about. That's the multifamily school. So we created a community of well-trained investors around the country. Not so much with the concept of, hey, let's sell you a bunch of mentorships and courses. It's more in line with, hey, let's create a collaborative community of well-trained investors that we've helped train, who can do deals together. They can partner together. They can raise capital together. They can actually do things, right? Because one of the biggest things you learn very quickly in multifamily specifically is that you cannot do it alone. You can try, but you're not going to get very far. And if you really, truly want to grow in it and get it, 50 units, 100 units, 200 units, whatever it is you want to do, collaboration and partnerships are how you do that. And that's how you raise capital together. That's maybe you do a co-GP, general partnership together. If you're going to take down a larger property, like 50 units or 100 units or whatever it is, most people are not striking checks for that alone. They're usually striking checks together for it. And so that's kind of the concept of the community, because now what's happening with it is we're partnering with our students on our deals around the country, where they may have started by getting their first 10 to 30 unit apartment complex with them and some people, but then they got confidence and they're like, dude, we want to go bigger. Like now we want to see a 50 unit or 100 unit. Well, you're not doing that alone. They're usually not taking that down alone. So they usually come to us because we've done it, and they'll say, hey, do you want to partner on this? Take a look at it. And then what happens is now we get to see a deal we wouldn't normally see, and they get to take down a deal they normally wouldn't get to take down.
No, I think that right there is really important for people learning about the space. Is find people to work with that, it's the information's out there for free. It's rational to charge for the implementation, and work with the people that are creating a community where what's really cool about it is you're essentially extending your acquisition arm of your business. So if you're going to get way more deals submitted to you, way more investors into your pipeline, and way greater opportunity to do stuff together. So Justin, it's really cool to see what you're doing. As we record this, you have about 150 million assets under management. And by the time we record another episode together, we expect you to cross over that $1 billion mark, man. Like, come on, get there.
We better start 10xing, baby. But our pencils are up. So as they say, because for the last 2020, 2022, 2023, most of it was down, except for one deal that we acquired. But now our pencils are up, and we are looking at deals. We have 2 deals that are actually launching here right now. One's 160 unit in Texas. Another one's actually a pretty cool Airbnb in downtown San Diego called the Dalton. Wait till you see this thing. This is pretty wild. Very unique. And I normally wouldn't get into that space, but we have some good partners on it.
There we go. And I hear Justin is offering Dan a free stay there. He's in San Diego.
We love it, baby. Yeah, it's a very cool deal. So I'll be launching it here online here pretty soon for people to take a look at it. So
sweet. Well, we'll make sure to put all those links in the show notes. Justin, it was an absolute pleasure having you on the show. And everyone, this is Mason McDonald with Dan Haberkas and the Big Picture Blueprint signing off.